$8 trillion erased in the 2000 dot-com crash, 16 trillion lost in the 2008 housing crisis, 2 trillion vanished in crypto winter 2022. Why does this keep happening? In 1637, a single tulip bulb sold for the price of a mansion. In 2021, a digital picture of a rock sold for $1.3 million. What's going on here? Imagine a vast pasture where bulls graze peacefully. One day, a bull stumbles upon something unusual, shiny pebbles scattered across the grass. They glitter in the sunlight. Beautiful, but ultimately worthless. Just rocks. Another bull trots over and says, quote, "0." The first bull is confused. It's just a rock, but he takes the deal anyway. Easy money, he thinks. This is where it begins. By the end of this video, you'll recognize the 5 warning signs before you lose everything. You'll understand why every generation falls for the same trap. And you'll see exactly how this pattern has destroyed wealth 4 times in modern history, and how it's setting up to happen again right now. So what is a market bubble? In simple terms, it's when the price of something, stocks, houses, tulips, digital images, inflates far beyond what it's actually worth. Not because of real value, but because of pure speculation. Because everyone believes someone else will pay even more tomorrow. This is called the greater fool theory. You're not buying to own. You're buying to sell to the next fool at a higher price. Think about it this way. A house might genuinely be worth $200,000 based on construction costs, location, rental income potential. But during a bubble, that same house sells for $800,000. Why? Because prices only go up, right? Wrong. That's perceived value completely detached from real value. And the formula is always the same. Price rises. More bulls rush in. Price rises more. Fear of missing out kicks in. Euphoria takes over, then collapse. Here's why this matters to you personally. The average investor loses 50 to 90% of their wealth when bubbles pop. Not the rich, not the insiders. You, the bull who bought at the top because everyone said it was safe. Let me show you how this happens. In our pasture, the pebble represents any asset. Tulips in 1637, internet stocks in 2000, houses in 2006, cryptocurrencies in 2021. The bull represents you, the investor. And watch what happens to the price. 2 coins becomes 10 coins, becomes 100 coins, becomes 1,000 coins. But here's the critical part. Bulls don't want pebbles for their stalls. Pebbles have no intrinsic use. They want pebbles to trade for more coins. The pebble isn't the point. The next bull's coins are the point. Did you know the average bubble participant loses their entire investment in under 72 hours? Think about that. Years of saving, gone in 3 days. Now let's watch how this mania unfolds, stage by stage. In 1982, economist Hyman Minsky identified 5 stages every bubble follows. 5 stages. Every single time. Different assets, different centuries, same exact pattern. Stage 1, displacement. Something changes in the economy. A new technology emerges. A policy shifts. A discovery happens. Early adopters see legitimate value here. In our pasture, a wise bull discovers that these pebbles can actually be polished into beautiful decorations. There's a real use case, real demand, real value. Think about the internet in 1995, blockchain technology in 2009, artificial intelligence in 2023. The displacement is real. The opportunity is real. At this stage, everything makes sense. Stage 2, boom. Smart money enters. Prices rise steadily based on actual fundamentals. Media coverage begins. Professional investors get involved. In our pasture, other bulls notice. Hey, these polished pebbles really are beautiful. My stall looks amazing. Prices rise from 2 coins to 10 coins. Still reasonable, still justified. Amazon stock from 1997 to 1999 followed this pattern. Bitcoin from 2013 to 2016. Value is growing because the underlying asset is genuinely improving, genuinely useful. Stage 3. Euphoria. This is where everything goes insane. This is where bulls lose their minds. New paradigm thinking takes over. This time is different, everyone shouts. The old rules don't apply anymore. Everyone and their grandmother is buying. Your taxi driver is giving investment tips. Your barber is trading on his phone between haircuts. Prices completely detach from any rational value. And here's where it gets dangerous. Leverage enters the picture. Bulls start borrowing coins they don't have to buy more pebbles. In our pasture, bulls stop polishing pebbles entirely. They're just trading them. Raw, unpolished rocks changing hooves at insane prices. Bulls borrow coins from the bank. Bulls sell their stalls. Bulls quit grazing entirely to trade pebbles full-time. And if you're a skeptical bull who points out that these are just rocks, you get mocked. Have fun staying poor, they yell. You just don't understand pebbles. This is tulip mania at its peak in 1637. This is .com in March 2000 when companies with zero revenue had billion-dollar valuations. This is housing in 2006 when mortgage brokers handed out loans to anyone with a pulse. This is crypto in November 2021 when digital images of cartoon apes sold for $500,000 each. Pause. Take a breath. Ask yourself right now, am I in stage 3 of anything? Are you holding something primarily because you think it'll go up, not because you understand its actual value? Be honest. Stage 4. Profit-taking. The smart money exits. Quietly. The wise bull who started this whole thing, he's been watching prices climb from 2 coins to 100 coins to 500 coins to 900 coins. And at 900 he quietly sells his entire position. All 500 pebbles. Massive profit. Other big bulls notice and follow. But here's the trick. Volume remains high. Regular bulls keep buying. Quote 7. They say. Quote 8. They genuinely believe prices will recover because prices always recover, right? Stage 5. Panic. Somebody asks the obvious question. A young bull looks around and says, quote 9. Silence. The illusion shatters. Everyone realizes at the same moment that they're holding worthless rocks. Panic spreads like wildfire. Every bull tries to sell, but there are no buyers. Zero. The pebbles that traded for 1,000 coins yesterday can't find a buyer at 100 coins. Then 50. Then 10. Margin calls start. Bulls who borrowed coins to buy pebbles get liquidated. Forced selling accelerates the crash. Prices collapse 70 to 95%. Bulls lose everything. The pasture is littered with bankrupt stalls and broken dreams. This isn't theory. Let me show you 4 times this exact pattern destroyed trillions in wealth. Case 1. Tulip Mania, Netherlands, 1636 to 1637. The original bubble. Tulips were new exotic flowers from Turkey. Genuinely beautiful. Genuinely rare. At the peak, a single tulip bulb sold for the equivalent of 10 years of a craftsman's salary, 10 years of work for one flower bulb. Futures contracts traded on tulips that hadn't even been grown yet. February 1637. The market collapsed in days. Fortunes vanished overnight. The lesson? Being first doesn't mean you're different. Even the first pebble craze ended in disaster. Case 2. .com bubble, 1995 to 2000. The internet was real, revolutionary technology, genuinely world-changing. But the valuations were insane. Companies with zero revenue, zero profits, and zero viable business models were valued in the billions. The metric wasn't earnings, it was, quote, 10. How many people visited your website? Pets.com raised $300 million in their IPO. 9 months later, bankrupt. The NASDAQ crashed 78% from its peak. $5 trillion evaporated. $5 trillion. The lesson? Real technology doesn't justify any price. Polished pebbles are genuinely useful, but they're not worth 10,000 coins. Case 3. Housing bubble 2003 to 2008. Everyone remembers this one. Quote 11 was the mantra. Subprime mortgages meant bulls were borrowing coins they didn't have and couldn't repay to buy pebbles at inflated prices. Ninja loans, no income, no job, no assets. They gave mortgages to anyone. Then they bundled these terrible mortgages into complex derivatives. Pebbles wrapped inside, more pebbles. When it collapsed, 10 million foreclosures, 16 trillion in wealth destroyed, entire families homeless. The lesson? When every bull in the pasture is trading pebbles, when your taxi driver is flipping houses, you're in stage 3. Run. Case 4. Crypto winter, 2017 to 2022. Actually 2 cycles. Bitcoin, thousands of altcoins, NFTs, digital pebbles. The technology behind blockchain is legitimate, but the mania was identical. Diamond hands culture emerged, mocking anyone who sold, calling skeptics poor and stupid. The Bored Ape Yacht Club, literally JPEGs of cartoon monkeys, selling for $400,000 each. FTX, a major crypto exchange, collapsed overnight. 8 billion in customer funds vanished, 70 to 95% crashes across the entire crypto market. The lesson? Technology changes. Generations change. Human psychology never changes. Same pasture, same pebbles, different bulls. Here's a real audio clip from the peak. Jim Cramer in 2008, quote 13. 1 week later, Bear Stearns collapsed. Or crypto influencers in 2021, quote 14 Bitcoin dropped 70%. 4 times, 4 generations, same exact playbook. And the total? Over $30 trillion in wealth destroyed across these 4 bubbles alone. But here's what nobody tells you. There are hidden factors that make bubbles even more dangerous than they appear. Misconception number 1. I'll sell before the crash. Everyone thinks this. Statistically impossible. Why? Because of psychology. During the boom, you're in the greed phase. Prices keep rising, so why sell? Then prices wobble, and you enter the denial phase. Quote 16. Then panic hits, and you're in the I just need to break even phase. But by then, it's too late. Our bull in the pasture promises himself, quote 18, price hits 500. The bull thinks, quote 19, price hits 1,000. Quote 20. Then crash. Reality check. 95% of participants try to sell during the crash, not before it. Misconception number 2. Quote 21. The diamond hands trap. This is dangerous. Unrealized losses are real losses because of opportunity cost. While you're holding pebbles that crashed from 1,000 coins to 10 coins, refusing to sell because they were worth 1,000 once, you're missing other opportunities. Inflation is eroding your remaining wealth. Life expenses pile up. Better investments pass you by. In our pasture, the bull holds pebbles worth 1 coin, refusing to sell because they were worth 1,000 before. Meanwhile, his stall falls apart because he spent all his coins on pebbles. He could have sold at 100, rebuilt his wealth, moved on. But he waited for 1,000 that never came back. Bitcoin, from its 2017 peak, took 4 years to recover. Many altcoins never recovered at all. They went to zero. Misconception number 3. Absolutely false. This is perhaps the cruelest part of bubbles. Insiders profit massively. Early adopters who bought in stage 1 sell to euphoric buyers in stage 3 and make obscene returns. Retail investors, regular bulls like you, always buy at the peak and sell at the bottom. The wise bull in our story bought pebbles at 2 coins in stage 1, sold at 800 coins in stage 4, 40,000% profit. The regular bull bought at 900 coins, panicked, sold at 50 coins, lost 95%. The system requires losers for winners to exist. It's mathematical. The top 1% of traders capture 70 to 80% of profits in bubble markets. You are not in that 1%? Sudden visual style change? Now this gets really dark. Beyond personal losses, there are societal consequences that outlast the crash itself. Economic scarring. Entire generations become risk-averse after major bubbles. Japan after 1989, an entire generation that never invested again. Millennials after 2008, scarred, skeptical, late to every market recovery. These effects last decades. Wealth inequality explodes. Rich bulls who sold at the top use their profits to buy real assets at discount prices during the crash. Good stalls, prime grazing land, productive investments. Poor bulls who sold at the bottom never recover. The gap widens. Policy consequences emerge. Bailouts, moral hazard, too big to fail. The big bulls get rescued while small bulls go bankrupt. And mental health? Suicide rates spike significantly after major financial crashes. Real people lose everything. Lives destroyed. In our pasture after the Pebble crash, young bulls never trust the market again. They hoard coins under rocks, never invest, miss real opportunities. The pasture's economy stagnates for a generation. Meanwhile, the big bulls who exited early buy up everything at fire sale prices. Inequality widens. The cycle sets up to repeat. Hey, I know this is dark, but you need to hear this. So what do? You can't hide under a rock forever. Here are 5 warning signs that you're in a bubble right now, and 3 strategies that actually work. Warning sign 1. Quote 25. If everyone around you is saying fundamentals don't matter anymore, if they're saying, I'll quote 26, or I'll quote 27 nice, you're in stage 3, run, warning sign. 2. Unprecedented leverage, people borrowing money to invest. Leverage is free money, thinking spreads. Margin debt hits all-time highs. In our pasture, bulls are borrowing coins to buy pebbles. That's the signal. Warning sign. 3. Celebrities and mainstream FOMO. When actors, athletes, influencers are shilling investments, when your parents and grandparents are asking how to buy, when there are Super Bowl commercials for crypto trading platforms, stage 3. Warning sign 4. Get-rich-quick influencers everywhere. Social media floods with quote 29 content, rented Lamborghinis, fake success stories, Discord and Telegram groups promising setting quote 30. All signs of peak euphoria. Warning. Sign 5. Insiders cashing out. Check insider selling data. Are founders selling stock or buying? Are venture capitalists quietly exiting positions? If big bulls are selling while small bulls are buying, you know where you are. If bulls are borrowing coins to buy pebbles, if celebrity bulls are endorsing pebbles, if big bulls are quietly selling while small bulls are frantically buying, you're in stage 3. Fly away. Now, 3 protection strategies. Strategy 1, the intrinsic value test. Before you invest in anything, ask yourself, what is this actually worth without speculation? If your answer relies on someone will pay more later, it's pure speculation. Focus on cash flow, earnings, utility. In bull terms, quote 33. If the answer is the latter, you're gambling, not investing. Strategy 2. Dollar cost averaging and diversification. Never go all in on anything. Invest fixed amounts over time. Spread your coins across uncorrelated assets. Keep 6 to 12 months of emergency funds in cash or stable assets. Don't put all your coins in pebbles. Keep coins for food. Keep coins for stall maintenance. Invest slowly and steadily. Strategy 3. Set rules before you invest. This is critical. Pre-decide your sell points, both up and down. Write them down. Tell someone. Remove emotion from future decisions. For example, quote 34, stick to it. Promise yourself before you buy. Quote 35, then honor that promise no matter what. Quick decision framework. Before any investment, ask yourself 5 questions. 1. Do I understand what this is? 2. Can I explain its value without mentioning price? 3. Am I buying because of research or FOMO? 4. Can I afford to lose this money completely? 5. Have I set exit rules? If any answer is no, don't invest. Remember, the goal isn't to get rich quick. The goal is to not get poor quick. Bubbles follow the same 5 stages every single time. History doesn't repeat exactly, but it rhymes. Displacement, boom, euphoria, profit-taking, panic. Someone will get rich in the next bubble. It won't be you, unless you follow the rules, unless you recognize the warning signs, unless you resist the mania when every bull around you is losing their mind over shiny pebbles. Now you know the pattern. You can't unsee it. You're equipped. Next time bulls start trading pebbles at insane prices, next time everyone says, quote 36, quote, next time your taxi driver is giving investment advice, you'll know exactly where you are. You can join the mania and lose everything. Or you can be the wise bull who builds wealth slowly, steadily, safely while others lose it fast. Picture our pasture after the crash. Some bulls learned nothing. They're already eyeing the next shiny object. But one bull, you, walks away with coins safely stored, heading toward real opportunities, real value, real wealth. That's the choice. If this video helped you avoid losing money, share it with someone who needs to see this. Subscribe for more economics that actually matters, and comment below, what bubble do you think is forming right now? I'll see you in the next one.